Welcome to the Deep Dive, where we take a stack of sources, articles, and research and distill them into the essential knowledge you need to be truly well-informed. Today, we're plunging into a question that sounds like it's ripped from a dystopian novel, but it's very much our reality. What if a single, largely unknown company, not a government or a tech titan, held the levers of the global economy? What if it influenced everything from the price of your flight ticket to the climate policies of nations, all while operating, for the most part, outside of the public spotlight? It's a truly astonishing idea, isn't it?
It is, yeah. And the most striking part is that this isn't a hypothetical. Today, we're diving deep into BlackRock, an American multinational investment company that, for many, has become synonymous with the phrase, the company who owns the world. Its reach and its power are nothing short of extraordinary, yet it manages to operate with a surprising degree of anonymity, in the public consciousness.
Right. So our mission for this deep dive is to unpack this staggering influence. We want to understand how BlackRock grew so powerful, what its concentrated power means for our daily lives, our global systems, and also explore the very real controversies that swirl around it. We'll try to break down complex financial and economic concepts into simple, digestible terms. We'll identify some key questions for you to ponder long after our conversation and connect the dots with clear, relatable analogies that hopefully will stick with you. Think of this as your essential guide to understanding a titan that most people have never truly heard of.
Exactly. And to guide you through this intricate web of finance, power, and influence, we'll start with a comprehensive bird's-eye view, just establishing what BlackRock is. Then we'll journey through some notable historical moments that really cemented its global standing, particularly during financial crises. From there, we'll dissect its current practices, the sort of engine of its growth and influence. And finally, we'll peer into the future, examining the profound implications of such concentrated private power on global capitalism and, well, governance. It's going to be an illuminating and perhaps even a little unnerving journey. So let's begin. Hashtag tag one, brief overview.
Okay, let's truly unpack this. When we talk about the company who owns the world, it sounds very dramatic, almost like the plot of a thriller. But at its core, what exactly is BlackRock?
Well, simply put, BlackRock is an investment company.
Right. It doesn't manufacture cars, doesn't sell groceries, isn't streaming movies to your living room.
Exactly. Instead, it manages money on behalf of other people, other companies, or even governments. Think of them as a massive, hyper-efficient financial steward, taking vast sums of funds and investing them strategically to generate returns for their clients.
So their product isn't something tangible you buy, it's the sophisticated management of capital itself.
Precisely.
And the scale of this operation is, frankly, almost incomprehensible. By 2025, BlackRock had a staggering U.S. $12.53 trillion in assets under management, or AUM.
12.3 trillion. It's hard to even visualize.
It is. To give you some perspective, imagine the entire economic output of nations. The total value of all goods and services produced in Germany annually is less than half of BlackRock's AUM.
Wow.
It's nearly half of the United States' nominal GDP from 2022. Which stood at around $25.3 trillion.
Sure.
To visualize this, it's roughly equivalent to the combined GDPs of Germany, the UK, France, and Italy.
So we are talking about an amount of wealth so vast that it truly redefines what a large company even means.
And this isn't just a domestic player either. Its global reach is genuinely worldwide. It boasts 70 offices across 30 countries and serves clients in over 100 nations. It is, by any measure, a financial colossus with an unprecedented international footprint.
What's truly fascinating here, and perhaps a key to understanding BlackRock's DNA, is its origin story. This global powerhouse didn't begin with some grand vision of world domination, but rather from a very specific and, well, even painful personal motivation.
Oh, really?
Yeah. BlackRock was founded in 1988 by Larry Fink and 7 other partners, including Robert Escapito and Susan Wagner. Fink's primary drive stemmed from an early, significant professional setback. A $90 million loss in the mortgage-backed securities market during his time at First Boston in the mid-1980s.
90 million. That's a big number, especially back then.
A huge number. And this wasn't just a minor error. It was a profound learning experience that became foundational for BlackRock. That loss imprinted on Fink and his team the absolute necessity of superior risk management and unwavering fiduciary practices.
Fiduciary meaning acting in the best interest of the client.
Right, exactly. They observed how other firms had approached the complex, often opaque world of mortgage-backed securities, sometimes without truly understanding the underlying risks. Their ambition, therefore, was to create a firm that could not only manage vast sums of money, but do so with an unparalleled, almost obsessive focus on identifying, analyzing, and mitigating risk.
So risk management was baked in from the start.
Absolutely. From day one, their early focus was squarely on providing institutional clients with sophisticated asset management services, but always through the lens of robust risk management. It was a direct, powerful response to their founding experience, like building a fortress around capital.
That deep-seated focus on mitigating risk clearly shapes their entire approach, making them a trusted partner when others were faltering.
Mm.
Now let's talk about their core business and offerings, because truly understanding how they make their mark is absolutely key to grasping their immense influence.
Right.
At its heart, BlackRock's business model is deceptively straightforward. They offer to manage money for clients, primarily through investing it for growth. And they earn a small commission or fee for this service, typically a percentage of the assets under management.
Regardless of whether those investments turn a profit for the clients or not.
Which is a crucial detail, isn't it? It's a remarkably simple yet incredibly effective model that ensures a consistent, predictable, and immense revenue stream for BlackRock itself, kind of insulated from daily market volatility.
Very much so.
Within their expansive portfolio of offerings, two key components really stand out and have been instrumental in their ascent. First, there's iShares, which is BlackRock's dominant product family of over 800 exchange-traded funds, or ETFs. For our listeners who know the financial landscape, you understand the power of ETFs. They are investment funds holding assets like stocks, bonds, or commodities, trading on exchanges like stocks.
And iShares is massive. By 2019, it alone managed over $2 trillion in assets, making BlackRock the world's largest ETF provider.
$2 trillion just in iShares.
Wow.
And what makes iShares so impactful is its accessibility, right?
Yeah.
It even offers monthly ETF saving plans, making sophisticated investing available to smaller retail investors, not just institutions.
Exactly. That broad appeal and low-cost structure have been a huge driver of their phenomenal growth.
Okay, and second, perhaps even more emblematic of their risk management heritage, is BlackRock Solutions.
Ah, yes, BlackRock Solutions. This division provides advanced risk management and investment analytics, most notably through its proprietary Aladdin system.
Aladdin. We'll definitely delve much deeper into Aladdin later because it sounds like the technological brain behind so much of their operations.
It really is. But for now, just understand that it's their advanced technological nerve center, a critical tool for managing vast, complex portfolios and assessing risk on an unprecedented scale. So, to help you visualize the immense scale and interconnectedness we're describing, let's use our first analogy. Imagine BlackRock not just as a large company, but as a kind of super mega corporation, or perhaps more accurately, a spider in a vast global web.
A spider? Huh?
Yeah, this spider sits at the very center. It's silken threads connecting countless aspects of the global economy, from your pension fund to major corporations, and even reaching into the highest echelons of government financial policy. It's not just a big player, it's a central node, a linchpin, in the global financial network, constantly sensing and influencing activity across its vast domain.
That image really paints a picture of deep connection and influence.
It does, and this image immediately brings us to our first knowledge gap question, a crucial one for understanding its unique position. Given BlackRock's immense size, its pervasive influence, and its central role, why is it not a household name like Apple or Amazon?
That's a great question. Why don't people talk about buying BlackRock in the same way they discuss iPhones or online shopping?
Exactly. And what does this relative anonymity, this operating largely behind the scenes, mean for its accountability and for public scrutiny? What is the fundamental distinction between an asset manager like BlackRock, which manages money, and a regular company that produces a tangible product or service we interact with daily? Why the difference in public profile?
That's something to think about, because a lack of broad public recognition could translate directly into a lack of widespread public oversight, even as its decisions profoundly impact so many aspects of our lives.
Precisely. It's a critical point. #Tech2, notable cases.
Okay, this is where BlackRock's story truly becomes fascinating, and for some, perhaps a little disquieting. BlackRock has repeatedly stepped into the role of a savior during moments of profound financial crisis, effectively taking on functions that are traditionally reserved for national governments or central banks. Let's examine two pivotal moments: the 2008 global financial crisis and the 2020 COVID-19 economic crisis.
Two huge global events.
Absolutely. In 2008, when the global financial system was teetering on the brink of collapse, submerged in a sea of opaque, toxic assets, BlackRock was not just present, it was indispensable. The U.S. government contracted BlackRock to analyze and unwind these incredibly complex and distressed assets from failing giants like Bear Stearns, AIG, and the mortgage giants Fannie Mae and Freddie Mac.
Basically, cleaning up the mess left by the crisis.
In a nutshell, yes. To simplify, imagine a complicated knot of financial obligations and risks that no one could untangle. BlackRock was brought in with its specialized tools and expertise to make sense of it. And why BlackRock? According to sources from Washington and Wall Street, it was unequivocally seen as the best choice, primarily due to its world-class risk analysis capabilities and its proprietary technology.
Aladdin again, presumably?
Exactly, particularly Aladdin. For these critical, almost governmental services, BlackRock received at least $180 million from the U.S. Federal Reserve.
A significant sum for basically helping steer the ship through the storm.
Indeed. Now, fast forward just over a decade to 2020 and the sudden, unprecedented shock of the COVID-19 economic crisis. History, quite remarkably, repeated itself. The Federal Reserve once again tapped BlackRock, not just for advice, but to actively manage two massive corporate bond buying programs, the primary market corporate credit facility and the secondary market corporate credit facility designed to inject liquidity and stabilize the economy.
So buying up company debt to keep credit flowing.
Precisely. They were also tasked with purchasing mortgage-backed securities again. Furthermore, BlackRock's advisory role wasn't confined to the U.S. It extended its expertise to Europe, advising the European Central Bank on the critical planning of its own stimulus programs.
Wow. So a transatlantic role in crisis management. This consistent pattern highlights a remarkable dependency, doesn't it?
It really does.
It's truly quite striking how BlackRock consistently becomes the indispensable go-to entity in these moments of profound national and international crisis. Our second analogy captures this perfectly. In these situations, BlackRock essentially took on the role of the state, acting almost like a long arm of the U.S. government or other central banks.
A long arm of the government. That's a powerful image.
It fits, I think. They were deciding the fate of struggling financial institutions and, by extension, the broader economy. They weren't merely advising, they were actively managing state-provided funds, determining which corporations would be supported, and advising central banks on the very structure and execution of their massive stimulus efforts. This blurring of lines between private financial power and public governance is a significant implication.
But this unique and powerful position was not without controversy, right?
Oh, absolutely not, and rightly so. Critics raise significant concerns about BlackRock's dual role, managing these government bailout funds while simultaneously being a massive investor in its own funds.
Which might hold stakes in the very companies being bailed out.
Exactly. This created the potential for what many called insider knowledge. Imagine having privileged information about which companies were about to receive government lifelines, potentially influencing your own investment decisions.
That seems like a huge potential conflict of interest.
It does. To address this, a cooling-off period of just 2 weeks was allowed before BlackRock employees could trade on information gained from advising the Fed, a period many considered far too short.
2 weeks? That seems minimal.
It does seem minimal. BlackRock, for its part, publicly pledged to forego profits from some of these government programs, stating it would return any additional income to the Federal Reserve. Still, the perception of a potential conflict of interest and the inherent information advantage remained a deeply troubling aspect for many observers.
Okay, so beyond its role as a crisis manager, BlackRock's pervasive influence truly extends through its vast and intricate web of ownership stakes. This is where the concept of the company who owns the world really starts to manifest itself in tangible ways.
Right, through the shares they manage.
Exactly. BlackRock is a massive shareholder, either directly or through its managed funds, in literally thousands of companies worldwide. We're not just talking about minor holdings. We're talking about significant stakes in global giants that touch your life every single day. Think about it. Apple, Microsoft, Facebook, now Meta, McDonald's, Siemens, BASF, Bayer, Airbus, PSA, Vivendi.
I mean, the list just goes on and on across virtually every sector of the economy.
It's almost easier to name companies they don't have a stake in. This isn't just passive investing. It means they wield a significant collective voice in the strategic direction and corporate governance of these companies.
And the scale gets even larger because BlackRock isn't alone at the top.
Right, there's the big three.
Exactly. Along with the Vanguard Group and State Street, it forms what is widely known as the Big Three index fund managers. These three entities collectively are the largest shareholders in approximately 88% of S&P 500 companies.
88%.
Yes, controlling around a fifth of all shares in the S&P 500, amounting to a mind-boggling $22 trillion in combined assets under management.
22 trillion between just three firms.
So while BlackRock is immense on its own, its power is exponentially amplified by its position within this powerful triumvirate. To make this concrete, let's look at Germany. BlackRock holds significant stakes in all 40 DAX companies, the largest German public companies, and is the largest individual shareholder in about one-third of them.
Wow. Which ones?
Including powerhouses like Deutsche Bank, Lufthansa, Bayer AG, and BASF. For instance, in 2022, BlackRock held 14.80% of Kragen and 5.23% of Deutsche Bank. These aren't small token investments. These are positions that confer real influence.
Definitely.
So, to use our third analogy, if financial markets were a crowded room, BlackRock and its peers don't just have a seat at the table, they have the megaphone.
They have the megaphone. I like that.
Yeah, they're not merely participating in the conversation, they're dictating much of its direction, setting the agenda and amplifying certain voices. This dominant position leads us to a crucial concept that has garnered significant academic and regulatory attention: common ownership.
Okay, common ownership. Explain that simply.
Right. So common ownership refers to a situation where the same powerful institutional shareholders like BlackRock, Vanguard, and State Street own stakes in multiple competing companies within the same market sector.
Okay, so owning shares in, say, Coke and Pepsi.
Yeah.
Or multiple airlines.
Exactly. If BlackRock holds significant shares in American Airlines, United Airlines, and Delta Airlines, it theoretically has an interest in those airlines not competing too aggressively on price, because that could erode the overall profitability across its entire portfolio of airline investments.
Ah, I see. So less competition could actually be better for the big shareholders holding stock in all the competitors.
That's the concern. Research suggests that this common ownership can indeed reduce market competition, potentially leading to higher prices for consumers, reduced innovation, and even higher CEO pay, as investors might prefer less vigorous competition among their various holdings. Now, this is a point of significant ongoing debate. BlackRock, while acknowledging the existence of such research, issued a white paper calling the mechanism vague and implausible, essentially arguing that their stakes are too small and their fiduciary duty too clear to exert such an anti-competitive influence.
They push back against that idea.
They do. However, it's worth noting that their own 2023 SEC annual report, a public disclosure of risks, identified common ownership as a potential business risk. This internal recognition, despite their public skepticism, suggests that even BlackRock understands the regulatory scrutiny and potential for adverse effects this phenomenon presents.
Interesting. Now let's bring this massive, almost abstract financial influence down to earth and examine its direct impact on daily lives. Because these aren't just abstract figures or theoretical economic concepts. BlackRock's investment decisions have profoundly tangible consequences for individuals, for labor, and for the very fabric of communities.
This is where it gets very real for people.
Exactly. Consider the highly publicized case of Stuyvesant Town, a sprawling, historically middle-class residential complex in New York City. BlackRock, partnering with a real estate firm, invested over $5 billion to acquire this massive property. Their stated goal: to convert its affordable rental units into luxury apartments, with the promise of a hefty 13% return for investors.
13% return, that's ambitious.
Very. But the human cost of this ambition was immense and immediate. This move led to immense pressure and distress for existing tenants, many of whom were elderly or low income, with some ultimately facing eviction or being forced out due to rising rents.
So, real people potentially losing their homes.
Yes. However, due to strong tenant resistance and public outcry, BlackRock eventually sold the property at a significant loss. What's crucial to remember here is that this loss, while a setback for BlackRock's immediate venture, was ultimately borne by the pension funds that had invested with them.
Ah, so the pensioners potentially took the hit.
Right. It highlights how investment decisions, even when they don't go as planned, have direct and often unseen consequences for individuals' retirement savings and financial security.
That's a really important connection to make.
We see similar stories playing out in industry and labor, particularly in Germany. Take the WMF example, a traditional German company renowned globally for its high-quality kitchenware and appliances. BlackRock, through its stakes in private equity giants like KKR, became a significant indirect owner of WMF.
Okay, so indirectly involved through another investment firm.
Correct. And the impact was swift and profound. This shift in ownership led to significant changes in working conditions, aggressive cost-cutting measures, and a strategic outsourcing of production, for instance. WMF's iconic cutlery, once a symbol of German craftsmanship, is now largely made in China.
That must have been a huge blow locally.
It was. The human toll was mass layoffs, with the number of employees in one key location plummeting from 7,000 to a mere 1,600. Employees described feeling their company was no longer the one they'd known and loved, a clear consequence of the relentless drive for profit maximization above all else.
A familiar story when private equity gets involved, unfortunately.
And for an even more localized, intimate example, consider the Siedlung, a social housing estate in Germany. BlackRock holds a 3% stake in TAG, a major real estate company that owns thousands of apartments, including this very estate.
Only 3%. That doesn't sound like a controlling stake.
No, but the consequences for the tenants were still dire. They faced neglected maintenance, deteriorating buildings, and a glaring lack of investment in their homes, as the company's focus remained squarely on profit distribution to shareholders and reselling properties at a higher value. This illustrates how even seemingly small stakes, when placed strategically in critical sectors like housing and amplified by overall investor pressure, can have a direct, detrimental influence on the quality of life for thousands of people.
So even a small percentage holding can contribute to a broader pressure for profit over maintenance or tenant well-being.
Exactly. These cases collectively demonstrate that BlackRock's influence isn't just about abstract financial figures. It directly affects where people live, how they work, and the very social fabric of communities around the globe. It connects their investment decisions to the tangible realities of human experience.
Absolutely crucial to remember that human element. #tag3 current practices. Shifting gears now, let's talk about the true engine of BlackRock's phenomenal growth. It's a strategy that many financial experts consider revolutionary, especially in the wake of the dot-com bubble burst. This is its pioneering of low-cost, passive investment strategies, the core of what BlackRock does for millions of investors worldwide.
Passive investing. So, not trying to actively pick winning stocks, but just tracking the market.
Precisely. Instead of attempting to beat the market through complex active trading strategies or by meticulously picking individual stocks, these funds simply track broad market indices, like the S&P 500 in the US or the FTSE 100 in the UK. This means that if the S&P 500 goes up, the fund goes up by roughly the same amount, and vice versa. It's about mirroring the market's overall performance, not outperforming it.
And this is cheaper.
Much cheaper. This automated process, often driven by sophisticated algorithms and minimal human intervention, is far less expensive than employing a large staff of active fund managers and analysts who are constantly researching, buying, and selling stocks. This efficiency is precisely what attracts a vast client base, from large institutional investors to everyday retail savers, all looking for long-term, stable returns at an incredibly low cost. This approach, pioneered and scaled by BlackRock, transformed the investment landscape.
Okay, but there must be consequences when so much money is managed this way.
There are significant consequences for the entire market. Because these passive funds are designed to track indices, BlackRock's funds are always heavily invested in the largest and most successful corporations within those markets. This creates what some economists call sticky money.
Sticky money.
Yeah. Their stakes in companies like Walmart, Apple, or Amazon are often so colossal that attempting to offload them would destabilize the entire market, harming their own clients in the process. This means, ironically, that these companies can almost always rely on the fact that BlackRock, Vanguard, and State Street aren't going to sell up.
So the biggest companies have these permanent, massive shareholders who can't easily sell even if they wanted to.
Largely, yes. And this situation fundamentally challenges the traditional idea of corporate governance, where investors are supposed to reward good management and punish bad by buying or selling shares, thereby influencing stock prices. If the big three can't easily sell or have little incentive to do so because they just track the index, it raises a crucial question. How effectively can they truly hold management accountable through traditional market mechanisms?
It shifts the power dynamic, doesn't it? Less about the threat of selling, maybe more about engagement behind the scenes.
Potentially, yes. It creates a very different kind of shareholder influence, less about exit and more about voice.
And behind a great deal of this, particularly the complex risk management and analytical prowess we discussed earlier, is what many call the brain of BlackRock, the legendary Aladdin system.
Ah, Aladdin. Yeah.
Aladdin is BlackRock's incredibly sophisticated proprietary risk management and investment analytics software system. The acronym itself stands for Asset, Liability, and Debt and derivative investment network, which hints at its vast scope. It's not just a fancy software program. It's a colossal piece of technology that operates on a truly industrial scale.
How powerful are we talking?
To give you a sense of its sheer power, Aladdin operates across 4 massive data centers, each humming with an astounding 6,000 supercomputers.
6,000 per center. Wow.
Right. This system performs an incredible 200 million calculations per week. It continuously assesses the value of potential changes in billions of dollars worth of assets, analyzing everything from granular global economic data and real-time stock prices to geopolitical shifts, government policy changes, and even the potential impacts of natural disasters.
So it's constantly scanning the entire globe for risks and opportunities.
Essentially, yes. It's designed to give BlackRock's portfolio managers a real-time, comprehensive, and forward-looking view of risk across their vast and varied portfolios, allowing them to make informed decisions with an almost unparalleled level of data.
And Aladdin serves a crucial dual function, doesn't it? It's used internally, but also sold as a service.
Exactly. Firstly, it is BlackRock's in-house system, the operational core guiding its own portfolio management teams and informing their investment strategies. But secondly, and perhaps more significantly for its broader systemic influence, BlackRock Solutions offers Aladdin as an external service. This means institutional investors, major financial institutions, and even central banks around the world, like a subsidiary of Deutsche Bank, pay BlackRock to use this system.
Which means Aladdin isn't just managing BlackRock's risk, but the risk of a huge chunk of the global financial system.
That's the astonishing part. The scale of its oversight is truly mind-boggling. Aladdin monitors the development of approximately 30,000 investment portfolios for over 170 external clients, representing about $20 trillion in assets under surveillance.
$20 trillion under Aladdin's watch.
An amount equivalent to 7–10% of all global financial assets. That is an astonishing concentration of financial insight and analytical power in one system.
And this brings us to a critical systemic risk concern. The UK's Financial Conduct Authority, the FCA, explicitly raised concerns in 2020 about Aladdin's prominent market position. They worried that such strong market concentration, with so many major financial players relying on a single analytical engine, could lead to what's known as herd behavior.
Herd behavior, like everyone making the same moves based on the same signals?
Precisely. If a large number of these users made similar decisions based on Aladdin's output during a crisis, or worse, if the system itself experienced a failure, it could potentially trigger or exacerbate systemic instability across global financial markets. It's an argument about a single point of failure on a truly grand scale.
What did BlackRock say about that?
BlackRock, for its part, emphasizes that risk analysis is an integrated part of every investment process, not a separate, isolated element that dictates strategy. They suggest their approach builds resilience through human oversight and diverse inputs, not just blindly following the machine.
Okay.
Now, beyond direct ownership and the technological brain of Aladdin, BlackRock exerts immense influence through its very nature as a financial trustee, which it frames as its fiduciary duty, and a practice it calls investment stewardship.
Right, they emphasize they don't own the shares. They manage them for clients.
Correct. BlackRock clarifies, quite rightly, that it primarily acts as a trustee for its clients. The shares it manages ultimately belong to its clients, pension funds, university endowments, individual investors, not to BlackRock itself. This trustee role is what they use to justify actively engaging with the companies they invest in, arguing they're protecting their clients' long-term interests. They have a dedicated investment stewardship team composed of approximately 70 expert analysts who actively communicate with company management and boards, representing BlackRock's positions and voting on behalf of its non-voting clients.
So they have a team specifically for talking to the companies they invest in.
Yes, they are essentially the proxy voice of trillions of dollars of capital. Perhaps the most visible and influential manifestation of this stewardship is Larry Fink's annual letter to CEOs.
Ah, yes, the Fink letter. That gets a lot of attention.
It really does. Every year since 2012, BlackRock CEO Larry Fink writes a highly anticipated and widely circulated letter to the CEOs of companies in which BlackRock holds significant stakes. This letter is not just polite correspondence, it's a powerful articulation of BlackRock's expectations and priorities, and it is widely discussed in corporate and financial circles, often setting the tone for boardrooms globally.
And what does he usually focus on?
Fink consistently advocates for long-term business models and has increasingly emphasized the importance of environmental, social, and corporate governance, or ESG, criteria. In 2022, for example, he highlighted the transformative power of capitalism and urged CEOs to embrace stakeholder capitalism, meaning considering the interests of not just shareholders, but also employees, customers, and the community.
Stakeholder capitalism, not just shareholder capitalism.
Right. He stated explicitly that this is not a political ideology, but rather a fundamental path to long-term profitability. Furthermore, Fink also announced BlackRock's voting choice program in 2021, which allows institutional clients, and later even retail investors in its largest ETF from 2024, to participate directly in shareholder voting or select from various predefined voting policies.
So giving clients more say in how their shares are voted.
That's the idea. However, critics like the Wall Street Journal's editorial board were quick to call this a false voting choice, as the pre-selected policies often had a distinct ESG alignment, raising questions about how much genuine, unaligned choice was truly being offered.
So the choices might still be steered toward BlackRock's preferred ESG stance.
That was the criticism, yes.
And that brings us directly to one of the most intense, multifaceted, and often politically charged debates surrounding BlackRock. The ESG debate, greenwashing versus conscientious capitalism. On one side, BlackRock has actively positioned itself as a leading proponent of ESG investing since around 2017. They've hired new staff, developed specific ESG-focused products, and advocated strongly for principles like gender diversity on corporate boards and supporting shareholder resolutions for climate action, famously against ExxonMobil in 2017.
They've definitely made ESG a big part of their public messaging.
Very much so. Larry Fink himself has robustly defended ESG investing as not woke, but rather a financially prudent approach, fundamentally aligned with long-term financial interests. He argues that companies with strong ESG credentials are simply better, more sustainable investments.
But this stance has been met with significant and often contradictory waves of criticism from all sides, hasn't it?
Oh, absolutely. On one hand, BlackRock faces accusations of blatant greenwashing. Despite its public commitments, environmental groups like Urgewald and Reclaim Finance point to its continued substantial investments in companies heavily involved in fossil fuels. For instance, reports indicate it held $11 billion in coal-fired power stations as of 2018, and a 2021 report claimed BlackRock still held at least $85 billion in coal investments.
$85 billion, despite pledges to divest.
Yes, despite earlier public pledges to divest from coal producers that derive over 25% of their revenue from thermal coal. Critics also cite investments in the arms industry and companies contributing to Amazon deforestation. A former BlackRock executive even publicly called ESG investing a dangerous placebo that ultimately harms the public interest, suggesting that financial institutions are motivated less by altruism and more by the higher fees they can often charge for ESG-labeled products.
So criticism that it's just talk, or even worse, a way to make more money while not really changing anything fundamental?
That's one side of the critique. But then, on the other hand, BlackRock has faced a furious political backlash, particularly in the United States, where the term ESG itself has become, as Larry Fink put it in 2023, weaponized.
Right, the anti-ESG movement has become very vocal.
Extremely. Fink publicly stated he had stopped using the term due to its politicization, though he later clarified he was not ashamed and still firmly believed in conscientious capitalism. This political weaponization has led to tangible consequences. Several U.S. states, including West Virginia, Florida, and Louisiana, have divested billions of dollars in state funds from BlackRock.
Billions divested because of ESG policies?
Correct. They argue that its ESG policies prioritize a woke agenda, or social activism, over maximizing investor returns. Compounding this, BlackRock's significant expansion into China has also drawn sharp criticism. It established its first mutual fund business there in 2020, becoming the first foreign-owned company allowed to do so.
That was a big move into a sensitive market.
It was, and it drew strong condemnation from prominent figures like George Soros, who called it a tragic mistake that potentially damages U.S. national security. Further, a U.S. House Committee investigation in 2023 concluded that BlackRock channeled approximately $1.9 billion into blacklisted Chinese companies involved in human rights abuses, or with direct links to the People's Liberation Army.
So deep involvement in China adds another layer of intense controversy.
Exactly. It's clear this is an incredibly complex, high-stakes, and deeply scrutinized area for BlackRock, navigating a minefield of conflicting expectations and political pressures from literally all directions.
It certainly seems like they can't win on the ESG front, attack from both sides. And this complex web of influence extends even deeper into critical government and central bank advisory services, blurring the lines between private financial expertise and public policy.
Beyond the crisis response we talked about.
Yes, beyond its high-profile crisis response roles, BlackRock operates a dedicated unit called BlackRock Financial Markets Advisory, or FMA. This division doesn't just manage money, it provides ongoing, specialized advisory services to major corporations, central banks like the European Central Bank and the U.S. Federal Reserve, and national governments globally.
What kind of advice?
For instance, FMA advised the ECB on the technicalities of its credit securitization purchase program and conducted crucial assessments of bank balance sheets for financially distressed countries like Greece and Cyprus. They're effectively using BlackRock's specialized analytical expertise, likely leveraging Aladdin, to guide national and supranational financial policy at the highest levels.
So, advising governments on how to manage their finances or banking systems?
Essentially, yes. And a persistent and significant point of controversy here is what's widely known as the revolving door phenomenon.
Ah, people moving between government jobs and BlackRock.
Exactly. BlackRock has cultivated a reputation for actively attracting high-profile former government and central bank officials to senior advisory or board roles within the company. We're talking about individuals with unparalleled access and insight, such as Philip Hildebrand, the former head of Switzerland's central bank, George Osborne, the former UK Chancellor of the Exchequer, and Friedrich Merz, a prominent former high-ranking German CDU politician.
Big names with deep connections.
Very deep connections. These individuals bring not only a wealth of experience, but crucially, those high-level connections within the very institutions BlackRock seeks to influence or advise. Critics raise valid concerns that these exceptionally close ties and BlackRock's extensive advisory roles could provide it with an information advantage over smaller funds or competitors.
The fear being they get inside information.
Yes, the fear is that BlackRock might gain unique insights into upcoming government policies, regulatory shifts, or economic conditions before this information becomes widely available to the broader market, potentially giving it an unfair edge. BlackRock, however, staunchly maintains that it uses robust Chinese walls, strict internal barriers and protocols to prevent the sharing of confidential information between its advisory and investment arms.
They claim they keep the advisory side separate from the investment side.
They do. They assert that insider trading is illegal and that they adhere to the highest ethical standards and strict codes of conduct. Despite these assurances, the European Ombudsman, for instance, opened a formal inquiry into BlackRock's contract to advise the European Commission on integrating ESG factors into banking rules, specifically questioning the impartiality of the advice.
Given BlackRock's extensive direct interest in the very regulations it was helping to shape.
Precisely. This demonstrates the persistent scrutiny and the inherent challenge of maintaining perceived neutrality when operating at such a vast scale and with such deeply embedded connections to global power structures. #tag4 future implications.
As we look ahead, the unprecedented scale and influence of BlackRock raise profound questions about its role in the global financial system and, indeed, its very nature. One of the most significant concerns revolves around its status as potentially too big to fail, and the ensuing urgent calls for more rigorous regulation.
The too big to fail label is a heavy one.
It is. BlackRock has been dubbed the world's largest shadow bank by influential publications like The Economist and Basler Zeitung. Now, for our informed listeners, the term shadow bank is critical here. It refers to financial institutions that perform many bank-like functions, lending, credit creation, managing liquidity, but critically, they operate outside the traditional stringent banking regulations that apply to commercial banks.
So they act like banks in some ways, but aren't regulated like them.
That's the core concern. This lack of traditional oversight, combined with their sheer monumental scale, naturally leads to significant calls for action. Several influential political figures in the U.S. have voiced these concerns directly. U.S. Representatives Katie Porter and Chuy Garcia, for example, have proposed legislation specifically aiming to restrain BlackRock and other shadow banks, advocating for greater transparency and accountability.
Trying to bring them more into the regulatory fold.
Yes. Even more forcefully, Senator Elizabeth Warren has suggested that BlackRock should be formally designated too big to fail and regulated accordingly, much like major commercial banks which face intense scrutiny and capital requirements. This designation would bring with it heavy oversight, stress tests, and other regulations designed to prevent systemic risk.
Which BlackRock would likely resist strongly.
Unsurprisingly, yes. BlackRock has actively engaged in extensive lobbying efforts to avoid such stricter regulation and to prevent being classified as systemically important, a designation that would fundamentally alter its operating model and profitability. It's also worth noting that, despite its internal controls and sophisticated systems, BlackRock has faced fines from Germany's Financial Supervisory Authority, BaFin, for violating reporting obligations, paying millions in penalties.
So not entirely immune to compliance issues.
No. While BlackRock attributed these to internal process issues, these incidents add fuel to the arguments for greater external oversight and highlight that even titans can have compliance gaps.
And if we truly connect this to the bigger picture, BlackRock's unparalleled rise points to an alarming centralization of global capitalism and a pervasive private power that profoundly challenges traditional notions of free, competitive markets.
How so?
Well, the pervasive common ownership by BlackRock, Vanguard, and State Street in multiple, often competing companies across various sectors raises genuine concerns that it could inadvertently lead to an economy-wide monopoly.
An economy-wide monopoly? That sounds serious.
It is. In such a scenario, major firms might be subtly, perhaps even unconsciously, discouraged from genuinely competing on price or innovation, as their ultimate shareholders benefit from a more stable, less aggressive rivalry across their vast portfolios. This isn't necessarily about explicit collusion, but about an alignment of interests that can dampen competitive instincts.
So the big three, owning everyone, means less reason for the companies they own to fight each other hard.
That's the theoretical risk. Some argue that these few giant organizations are essentially becoming the new permanent owners of the world's largest corporations, and significantly even critical infrastructure, everything from schools and bridges to wind farms and, as we saw, people's homes.
Owning the actual infrastructure of society.
Yes. And their control over these foundational assets is, naturally, used to maximize returns for their clients. And critics suggest this can involve relentlessly squeezing profits. This can manifest as hiking rents for vulnerable tenants, as in the Stuyvesant Town case, or charging increasingly higher fees for the use of essential infrastructure.
Squeezing profits from essential services.
That's the accusation. Research, for instance, indicates a significant concentration of power, showing that 3/4 of the world's 205 largest firms by sales are linked to a single global company network of concentrated 5% ownership ties.
3/4 linked through ownership. That's a tight network.
It is. This is not an abstract concept. It illustrates a deeply interwoven and powerful global network that operates somewhat invisibly. Critics go so far as to argue that this concentration of wealth and power is fundamentally creating a new aristocracy that governs the world in its own way, leading to a rapidly more unequal world where, quite simply, only those with money can increase it, further exacerbating wealth disparities.
A new aristocracy. That's a powerful claim. And this is truly where it gets profoundly thought-provoking, because BlackRock's influence isn't just financial or economic. It has profound, and some would argue, expanding global political ambitions.
Moving beyond finance into politics.
Some observers have described BlackRock as almost a global fourth branch of government, due to its extensive and growing influence across international political and economic landscapes. The revolving door phenomenon, which we discussed earlier, continues to be a major source of concern here, but on an even grander scale. The practice of high-ranking government officials moving into BlackRock and vice versa. Larry Fink himself has been repeatedly rumored to be shortlisted for U.S. Treasury Secretary in a potential Biden administration.
Which would be the ultimate revolving door move.
It would blur the lines between private financial power and state power almost completely, placing a key architect of global finance directly at the helm of national economic policy. BlackRock's international advisory roles further underscore this political reach. It manages U.S. securities purchases for the Central Bank of Israel, a role of immense strategic importance.
Managing assets for another country's central bank.
Yes, and handles Mexico's pension funds, giving it intimate access and influence over national financial systems. In a very recent example from August 2023, BlackRock signed a landmark agreement to establish a NZ$2 billion investment fund in New Zealand, specifically earmarked for renewable energy projects.
So directly funding national policy initiatives now, too.
Exactly. This is a clear and compelling demonstration of its expanding influence in not just financing, but actively shaping national economic and even environmental policies on a global scale. To tie it back to our earlier imagery, BlackRock operates like a spider in a net of power relations, strategically positioned to influence political and economic decisions across borders,
Wielding its financial might to shape the world beyond mere investment returns.
becoming a silent yet powerful force in global governance.
This comprehensive overview of BlackRock's operations and influence inevitably brings us back to some crucial questions for you, the listener, to consider. First, if BlackRock's influence is indeed as pervasive and deeply integrated as our sources suggest, what are the most effective, concrete steps that governments, regulatory bodies, or even individuals can realistically take to ensure accountability, transparency, and fair competition in global financial markets?
That's our second knowledge gap question, right? What can actually be done?
Exactly. This isn't just a theoretical challenge, it's a practical one that demands innovative and robust solutions given the sheer scale and complexity of this entity. How do you regulate something this big and interconnected?
A huge question with no easy answers.
Balance its fundamental fiduciary duty, its legal and ethical obligation to maximize client returns, with its publicly stated commitment to ESG factors. However, as we've explored, these are often, if not inherently, conflicting objectives, particularly when the E or S might impinge on short-term profits.
Profit versus planet or profit versus people.
Essentially, yes. How can these often conflicting objectives truly be reconciled in practice, and what does this ongoing tension mean for the future of genuinely socially responsible investing? Is it genuinely possible to achieve both, or will one objective inevitably, even subtly, compromise the other in the long run?
Another critical question. Can you truly serve two masters when they seem to pull in different directions?
It goes to the very heart of modern corporate ethics and the purpose of capital.
Today, we've taken an incredibly deep dive into BlackRock, tracing its journey from its origins and risk management, spurred by Larry Fink's personal experience with loss, to its current status as the world's largest asset manager. We've explored its dual and often controversial role as a financial giant and an influential government advisor, and the intricate debates surrounding its pervasive impact on everything from global financial stability and market competition to local communities and crucial environmental policies. It's a company operating with truly immense power, often just beneath the surface of broad public awareness, yet undeniably shaping our world.
And as Grace Blakely argues in her compelling book, in a truly free market society, pervasive private power should not exist. This raises a critical, even provocative thought for you, our listener, to ponder. What does the unparalleled rise of BlackRock, an institution that influences and in many ways controls markets, shapes the lives of workers, impacts communities, and even advises states, tell us about the true evolving measure of modern capitalism? And perhaps more importantly, what kind of future are we collectively building when such concentrated private financial power holds so many of the world's reins?
Powerful questions to end on. Thank you for joining us on this deep dive. We hope this exploration has given you not just new insights, but perhaps some important and unsettling questions to ponder about the powerful, often unseen forces shaping our interconnected world.